Hello and welcome to the good, the bad, and the ugly of all things real estate. I am Sherilyn Milsom. Today we are talking about the good, the bad, and the ugly of all things real estate. So who am I? I am an award-winning full-time real estate investor since 2006 and I've been educating landlords and investors since 2010 using creative real estate strategies since 2009. And I've had zero of my own money in our corporation, and we've bought a multi-million-dollar real estate portfolio, seven-figure real estate portfolio in the corporation with again, zero of my own money. So it's been pretty awesome. Been featured in a bunch of different magazines in addition to being on stage across the country. Just a bit of housekeeping, make sure you mute your mic. You can ask questions in the question period, and make sure you click sign up on Facebook at the top of the page in the banner to join our mailing list if you haven't already, because if you're on our mailing list, then you will get the replay of this as well as the slides. All right. And now, first of all, the good, the bad, and the ugly of zero down purchases depends on how you are buying. So there are several ways to purchase with zero down and still have 100% ownership of the property. You can have a gifted down payment. Some people are beneficial and lucky to have that happen to them, but usually it only happens once, if at all. And we're not really talking about that today because there aren't really many downsides if you have a gifted down payment. You can have a true zero down mortgage where the bank puts 100% of the purchase price in the first mortgage. That used to happen fairly often. I don't think that has happened in quite a few years, but I do have a couple of those myself. And so I know a little bit about them, and that you never know, that could happen again. You can borrow your down payment from the bank with a line of credit. That is more common with owner-occupied purchases rather than rentals, but it still could potentially happen with a rental, depends on the bank. You can always borrow down payment from a private lender. And of course, there's always my favorite, which is a seller financed purchase. That's where the seller stays on mortgage and title, and you work with the existing financing. So we'll cover the good, the bad, and the ugly of pretty much all of these. We are not talking about joint ventures today because although you're buying with zero down with a joint venture, you don't have 100% ownership. All right, first of all, the bad of buying with zero down payment. You have, so if you are buying with zero down payment, then you are going to owe more, and the more principal you owe, the slower your pay down rate is. So think about it. When you first buy a property, even when you buy it with 20% down, your annual mortgage pay down is kind of small compared to a property that you've owned for 10 or 15 years. So now if you buy a property with zero down, that annual mortgage pay down is going to be really, really small. So that's a benefit you're losing when you buy with zero down payment. It's going to take you a lot. You're going to pay a lot more interest up in the first few years. And anytime you owe a lot of money, it's going to have a negative impact on your debt coverage ratio because you're going to be paying extra payments usually on these down payments, whether it's borrowed from the bank or borrowed from a private lender. That's going to count against your debt coverage ratio. And of course, that could complicate future mortgage applications when you have a higher debt coverage ratio. My tongue's a little tied today. Please bear with me. More bad things about buying with zero down. If you have a bank financed down payment, of course, you're going to incur interest. And if you have that's being really slow, private financed, you've borrowed from a private lender down payment, that's going to have high interest. Often it's going to be double-digit interest rates when you buy through or borrow from a private lender. And especially now that the bank's interest rates have gone up, so will the private lender's interest rates. And if the debt that you've borrowed is not able to be secured against one of your other properties, and you've got an unsecured loan for that down payment, then your interest rate is going to be even higher because the higher the risk for your lender, the higher the reward for them too. So it's going to be much higher interest if they can't secure it. And you have to consider whether you're going to be able to do fixed or variable rate on that private, especially if it's a private loan. If it's a bank line of credit, it's pretty much always going to be variable. But if it's a private loan, you might be able to lock into fixed. And it depends on what source they have for their funding. If they're borrowing their money to give to you, if they've got a secured line of credit that they're borrowing from, you're probably going to be stuck with a variable rate, which means that interest payment could go pretty high. And you could be stuck with negative cash flow, because if you are making payments on your borrowed down payment on top of your mortgage payment, that could quickly eat up all of your profits. That could put you in a financial bind as well, especially if you do a bunch of these properties with negative cash flow. Maybe the rest of your portfolio can't carry those, and you could be costing yourself money out of your pocket every single month. And if you have negative cash flow, of course, that's a terrible debt coverage ratio, and that's going to have a bigger impact on your ability to qualify for more mortgages. Now, if it's seller financed, again, that is when you work with the existing financing that the seller already has, if any, and then you work out details for any equity. So basically, the seller is 100% financing the purchase of the property. They stay on the mortgage, if there is one, they stay on title, and you work out all of the financing details directly with them. So that's what seller finance purchases are. Now, the bad side of those is eventually the seller is going to want to get off mortgage and title. So you're going to have to eventually sell or refinance in order to cash out the seller, so to speak. And you can't ride out the storm with an unfavorable market if the renewal with that seller is not an option. So, for example, we always have the ability to renew at least once. But if we need to renew a second time, that might not be an option. And then we might be forced to get our own financing on the property, and it might not be a favorable time. Now, the ugly for buying with zero down. There are a few ugly points. Negative cash flow can end in disaster. I haven't seen this from somebody who bought with a borrowed down payment, but I have with someone who bought properties with bridge financing, which is also a higher interest payment. And they ended up in a serious negative cash flow problem when the market turned. They couldn't refinance, and they ended up losing all of their properties. And I don't know if they went bankrupt, but they definitely lost all their properties in foreclosure. So it could end in disaster. You could have a balloon payment, especially if you are borrowing a down payment from a private lender. And if that balloon payment comes due and you don't have the cash, you might have the only option being sell the property. And if it's a bad time to sell, you could end up with money out of pocket. Also, if you have no equity in the property still, or the market has really turned, meaning now again you have no equity, because you're starting out with no equity, you could end up with negative equity and be really out of pocket if you're forced to sell. Now, if it is seller financed, there are a couple very specific ugly points to that situation. Time does not heal all wounds. So unlike regular real estate, where, as I mentioned, you can ride it out and just wait for the market to turn, you can't always do that with this. There are times where the seller is unable to renew. Perhaps the bank's mortgage company won't renew. In fact, in one case, everything was paid, and usually if everything's paid, then it's not a problem. But in one case, this one bank that a colleague was working with decided they are no longer working with rental property mortgages, and so they would not renew the mortgage. So this person needed to either sell or get a mortgage with another mortgage company. And in this case, neither was an option. So they were forced to sell. Sorry, that was the only option, was being forced to sell. And you may need to sell at a loss if, again, you're forced to sell at a bad time. But of course, there are good points to buying with zero down. The first and most important is that cash is in your pocket still, and you can do whatever you want with it. So one possibility is to buy another property. So basically, you've got your first property for 0 down, you're paying 20% down on the second property, you're getting 2 for the price of 1. That's a pretty good deal. And you can use the money to renovate that property that you're buying with 0 down and then sell it, or renovate and refinance. So by buying with 0 down, you can avoid the expensive bridge financing. So getting a borrowed down payment from the bank's line of credit, for example, is going to be a whole lot cheaper than bridge financing. And you can use that money for other projects, other renovations on other properties, or even investments that aren't real estate. Although, why would you want to invest in something that isn't real estate? I have no idea. And if the deal is seller financed, my favorite thing is you have no mortgage application. So you're working with any existing financing, and then all the other financing is dealt directly through the seller. You figure that out between you. So no mortgage application. And you can get excellent terms sometimes by working with that existing mortgage. And of course, you might be inheriting the interest rate that was set up 2 years ago when interest rates were, 1.5, instead of buying now with a 5.8% interest rate. So that can make a huge difference to your monthly profit and your bottom line. And your debt coverage ratio is not affected because you're not on the mortgage. You can bypass the dreaded mortgage wall by working with seller financing. And often there is no balloon payment for any equity owing until you eventually refinance or sell. So it's kind of like a 0 interest loan, although usually we pay a little bit of a premium price just for the privilege of 0 down. But that's something we'll talk about later. Now, you may have negative cash flow if you're working with seller financing, but usually that's because the seller has bought this as their personal residence and they're on accelerated pay down. So that little bit of negative cash flow is usually going towards the principal. And so if you're putting 0 down and then you have to pay $200 a month out of pocket, but it's going towards the principal, it's kind of like you're paying a $200 a month down payment. That's a pretty sweet deal. All right, so the bottom line with seller finance 0 down is 0 down plus no mortgage application means you have unlimited purchase potential, which is pretty cool. Now, does anyone have any questions? All right, so I have a few suggestions for working with 0 down. First of all, just because you can buy with 0 down doesn't mean you should. The numbers have to work. If the numbers don't work, then don't do it. And you should always have plans A, B, and C. So that applies to whatever balloon payment there might be. If the interest rates could go up, what are you going to do if the market turns? You need to have a lot of plans if you're buying with 0 down, because with 0 down, you have 0 equity. And you need to know your local market. If I'm buying a 0 down property, I want it to be something that is plain vanilla, something that is really easy to resell or sell quickly if need be. And of course, if you're working with something like seller financing that's a bit more advanced, you should definitely get some help from somebody with some operational knowledge. And speaking of which, I do have a webinar coming up on the 28th of February, free webinar that is specifically dealing with how to do seller finance purchases and with what we call an agreement for sale purchase. So that is on February 28th at 7 p.m. And for everyone who is on our mailing list, I'll be sending you that link. It's also, if you click the sign up button at the top of the Facebook banner, that will also get you to this link to register for the free training. And it won't be live on Facebook. It will be a private webinar. So you do need to register for this. And we will go deep into how to work with seller financing and how you can get some 0 down deals for yourself. So make sure you click the sign up on the Facebook banner if you're not already on our mailing list. If you are already on our mailing list, then you'll get the details sent to you. And leave a comment on Facebook or email me and let me know what you thought of the webinar or the session here today. and also what you'd like to see on the next Good, Bad, and Ugly of all things real estate, because I want to help you with whatever real estate questions you have. All right, so if there are no questions, then that is it for today. So thank you so much for joining me, and I will see you next time.